Investors and traders, welcome to the channel Market Chart Pattern. Today is 9th of March 2025. Hope everyone is having a fantastic weekend. This is going to be a pretty important video. The US stock markets have been under a fair amount of pressure recently in the past week, and they are at a really important point, which in my opinion is an inflection point. So this video we are going to discuss that. So the main topic will be whether this market is actually what we have seen, the sell-off. Is it a pullback in a bull market, or is it the end of a bull market and perhaps start of a bear market? So really key inflection points where we are, and this is what we'll be discussing in the video. As always, the video is for educational purposes only, and it is not a financial advice. So the key index that we will be focusing on is actually the NASDAQ 100. This is the chart of NDX, which is the NASDAQ 100 cash. So far it's been down about 11% since the highs the index reached in 2025. And the key development as of past week is that it is the first time in quite a while, and since 2024 August, that the market closed below the 200-day moving average. We had this day where it closed. The next day it was actually down, and then it rebounded, pretty much closing where the 200-day moving average is. The significance of 200-day moving average is that, of course, it's a really long-term moving average, but also a lot of trend following systems, in my opinion, they like to use this average as well. And once the markets begin to close below this level of 200-day moving average, then it triggers something in their system, and they begin to monitor it. And perhaps if the market begins to continuously trade below this, they might begin to exit some of their positions, perhaps because it is generating a sell signal. So this is how I look at these long-term averages, as a trend following system. Now if we just take a look at what happened in the market, the key point is it's at a inflection point because of the close below the 200-day moving average. Now the key question being, is it a pullback in a bull market, or is it the start of a bear market? So this is what we'll try to answer in this video. Now the critical point is that, let's take a look at the next slide, that what we have seen in terms of the data, if we go and take a look at historically, then if the NASDAQ 100 after closing below the 200-day moving average for the first time in quite a long while, for the next 10 trading days, which is about 2 weeks calendar days, fell more than 4%, then stocks actually fell a lot more. In other words, it was a start of a bear market, and in some cases even pretty severe bear markets, which we'll take a look at in the following slides. And this happened in 1990, when before the recession call of 1990. It also happened in 2000, just before the dot-com crash. In 2008, at the beginning of 2008, which was at the start of the GFC, the Great Financial Crisis. And in fact, the markets had topped, such as Dow, back in July of 2007, and some of the other indices perhaps topping in October. And then 2022, more recently, before we saw a bear market happening because of the inflation. And the central banks all over the world, especially the Fed, they really hiked the interest rates in a short span of time, which was something we have not seen before. So let's begin to examine some of these charts. So this is the case of 1990, and what we see here is that we had a close. Now the picture that I've drawn right here, these are I had to draw them a little bit on the left hand side, just so that there was enough space we could see the things. So right here is the point where the market closed on the below the 200-day moving average. Now this is of course historic data, so things look a lot more clear, but when it's happening in real time, sometimes one or two bars could overlap. And then what we have seen is that after closing below the 200-day moving average, for the next 10 trading days, the market actually fell more than 4%. So the decline was more than 4%. One additional thing that I've added is actually the Fibonacci retracement from a key low. The market did retrace way beyond the 4%, in fact, minus 8.3% roughly. But what it also did was, because it was above the 38.2% retracement, it started a rally, which turned out to be sucker's rally, and it topped after getting above to the near to the 1.272 expansion of this entire move, and then we had this real big sell-off. So this was actually a tipping point that this rally might actually have been a bear market rally, which it turned out to be. So this is where this signal came in. Now if we go and take a look at the mid 2000s, so we have the case again where the market closes below the 200-day moving average, and over the course of next 10 trading days, so the close came in, I believe, a little bit around here. Then what we have seen is actually the market in the next 10 trading days declined more than 4%. And then, of course, there are going to be rallies. There were some really fantastic rallies, which actually went to the 61.8% of this entire decline. And that's where it was not able to rally any further. So, in fact, did a double top formation right here. And it was basically the start of the 2000.com crash. And, it was a level for many years. The NASDAQ actually was not able to recover because it went down by about 70%. So this was a signal generated. This is why we're paying really close attention to this. Now, this is going back to the early 2008, something happening here again. And what we had was basically the market closes on the daily basis below the 200-day moving average. And then in the next 10 trading days, approximately, which is going to be 2 weeks in terms of calendar days, the decline is more than 4%. And in this case, it's actually also below the 38.2% retracement. And then what we had a bear market. And there were, of course, rallies, but they were really strong, vicious rallies in a bear market. This is the thing about bear market. The rallies could be very strong, but they will typically fall short of basically taking out the swing high. So for example, this one was not able to take this swing high. This one was not able to take this swing high, so they will begin to form double tops. And this is the reverse in the bull markets. In the bull markets, we begin to see a lot of double bottoms. So we saw, of course, what was the GFC, and the market continued to decline a lot more further, but we have this signal being generated. Now if we come back and take a recent example to the early 2022, when we also have this case where the market was closing below the 200-day moving average in a long time. So you can see previously it was right back some in March of 2021, so a long time ago. And in the next 10 trading days, we saw the market decline further than 4% range of the 200-day moving average. And what resulted was actually a move which was much deeper. And it bottomed in October of 2022, which is approximately 18 months before the election year, when the election took place in November of 2024, which is kind of a typical cycle that operates in the market. And this is something I'll do a separate video about it, because the next election year is quite further away, but it will be a really interesting case study for us to take a look at. So this was another signal that was generating, and all of these were pretty massive declines because they were bear markets, and some of them really severe and vicious bear markets. Now let's see the case when the market actually rebounded big time, because there have been cases where the decline was more than 4% in the 10 trading days, next 10 trading days, and the market declined within the range of more than 4% in the bear cases. But if the market was more of range bound, or from the first time it closed below the 200-day moving average, it kind of ranged between the 4% mark and was able to put in a bottom, or that level was a pretty strong defense for the market, then we had really nice rallies or rebound actually take place. And that happened in 1992, 1996, 1997, 2004, 2010, 2014, and more recently 2018. And you can see that here there's a bit of a sequence. There's 4 years here. This one was well, less than 4 years, of course. This one is a little bit more, but here we had 2004 and 10, 4 years, then another 4 years, and another 4 years. So perhaps there is some 4-year cycle that exists, but there were a lot more such cases than the extreme bear cases that we saw earlier on. So let's take a look at 1992. So here in early 1992, the NDX was in a range when it closed below the 200-day moving average for the first time in a long while, right here. Then it actually, the decline was in the range of about 4% approximately, and of course it also remained above the 38.2% retracement of this kilo right here. And what we saw was actually the market going sideways for quite a while. Actually, you can see that this is middle of March, and then the final bottom is coming in sometime in August, and 38.2% retracement never being broken to the downside, which is something we like to see. And then a massive rally, and the market rallied to about 1.27 to expansion of this entire decline. This is what happened in 1992, and if we take a look at in 1996, 4 years after the 1992, we have this case. I've drawn it like a little bit side here to make things more clear. But the market, for example, closed below the 200-day moving average right here for in quite a long while. You can see that, so it's declining below this 200-day moving average for the first time. And then what we see is in the next 10 trading days, the market is within that range, and it never actually went beyond the 4% decline. So it was a pullback, and then that gave the signal, and nice rally to the 1.27 to expansion of this entire decline. And then we have the next case is 1997. In 1997, what we have is a case where the market actually declines right here below the 200-day moving average. Now these are, because we're looking at historic data, so things are a little bit smooth out, but when they're happening in real time, it's a little bit difficult to judge at times. We can see these lows, the market is just hugging these right here. But if we just take even this one, we can see that the decline was about 4% in the next 10 trading days, and the market puts in a double bottom, and then it rallies off, it goes. And then we have the 2004. In fact, I've just got two examples of this, but if we just take one example right here, where momentarily it goes below the 200-day moving average on closing basis within the next 10 trading days, nothing happens, no more further decline, more than 4%, and then we see a rally, then it comes back, does something similar, double bottom formation, then rallies higher. And then we have another case where actually the market went far below, so the correction continued. But in terms of the signal was that for the first time in a long time, the market closing below the 200-day moving average for the first time, if in the next 10 trading days it doesn't decline more than 4%, then we are looking at a scenario which is more likely a pullback than a start of a bear market. Now this is more recent in 2018, and what we have seen is right here, the market actually closes below the 200-day moving average in a long time for the first time. And then what we see is in next 10 trading days, it doesn't decline more than 4%. Now the correction does continue and end in a really nice, beautiful ABCD, but that was a signal telling us that perhaps this is more of a pullback than the start of a bear market, where these lows would eventually be taken out. So this is really, really interesting what we are looking at. And now here we are in 2025. So the key question is, what are we looking at? Now, right here, we had this case when the market closed below the 200-day moving average, which is the NASDAQ 100 cash market, in a long time, because the previous time we saw was actually in August of 2024, but we can see that even this was not a close below. This was even before that, so we can ignore this as an edge case, in my opinion. And what we are looking at now is the market has declined roughly about 2%. So what we are looking at is now how the market is going to trade over the course of next 2 weeks or next 10 trading days, because that will give us our answer. If the market remains range bound like this, maybe rallies from here, but does not decline more than 4% since first time closing below the 200-day moving average, which is right around here, then it's more of a case that it is actually more of a pullback, and we are going to see a market rising again. So that will be a pullback scenario if the market actually next 10 trading days, approximately 2 weeks, is under pressure, and after crossing for the first time below the 200-day moving average, it declines further than 4%. That will also give us an answer that perhaps we are looking at a different kind of a market, where the characteristics of the market has changed, and we need to actually view the market and our positions accordingly. Now, the reason that I'm using NASDAQ than S&P 500, which is a collection of 500 stocks, is because the environment that we are in, it is really a tech-driven market, especially in the past 3 years, and since the lows which came in March of 2020, and the Magnificent Seven, a lot of concentration in those stocks in this bull market since the past 5 years. So it's really, really important because of their ratings in a number of ETFs and indices, at how those stocks will actually trade. So this is why we are in this tech-driven world, tech-driven economy. I'm paying a lot more attention to the NASDAQ index in comparison to even S&P 500, which is a broader index of 500 stocks. So this is what we are watching, and this is, I think we'll get our answer in a clear way in the next couple of weeks. But right now, where the market closed, there is several signals we are getting of a bottoming formation, and I've done a video on the technology stocks. Please do have a look at it. I will put a link to the video in the description. And we are seeing some of the key stocks that we watch are also forming key patterns at key levels, which might actually be bottoming signals as well. So at least we are going to see probably we're in the making of a rally quite near time. We might see that. Then we'll have to look at the quality of that rally, and then of course the 10 trading day 2 weeks window that we are watching will give us our final answer. Now just a bonus slide here. If we were to just go back and have a look at when the market topped in 2007, and just when the GFC started, it was really a nice ABCD, which was 1.272. And what the market has done now is actually again an ABCD, where the CD leg is approximately 1.272 times the AB leg. So we have a similarity with what happened several years ago as well. So you can watch that in the previous video. So I'm not going to go into the details of that, and I'm just doing this video in a PowerPoint presentation just because I don't want to forget any chart. If when I'm doing the analysis, sometimes I miss something that I want to say, so I did it in this format so that I do not miss anything. Now let's take a look at some of the sectors, because it's been a while since we have had a look at this. So let's start with XLF, which is the financial sector. So here it met our target of 49, probably a little bit shy of our ABCD target, which is around 53 roughly. And then we have seen a pretty big pullback right here. The chances are it's got maybe a further to go. It should still be okay, because in this entire melt up higher, this is the biggest BC decline that we saw. And once it begins to go below this level, especially around 44.50, which is 38.2% retracement, things might begin to change. But we have seen big declines in stocks like such as Goldman Sachs and even JP Morgan as well, Bank of America as well. Now this is the KRE, which is the regional banking ETF. We had our target of the 78.6% retracement. Once it touched that, and it's just been moving lower. I think it's really at critical support here. That's the 38.2% retracement, also a trend line. Getting below this, I think things will not be looking that great for the regional banks, and maybe that begin to also spill over into some of the bigger names as well. Energy is just range bound, doesn't look that great, but it's also not going down as well. So what it is telling us something. So we'll just keep on watching this really range bound price action. It hits double bottom maybe, and then double top right here, more likely to trade in this fashion. The nice thing was it had completed this ABCD right here, then had a rally, then double bottom right here. It remains above 200-day moving average. I believe it is more likely that the energy remains range bound. Then utilities, they have performed much better. Went right to the 1.272 expansion, didn't hit the exact number exactly, and now they have had a pullback right here. Still got a chance, maybe it can complete this ABCD right here, but it needs to maintain its trend line and also these averages right here. Now if we look at the staples, staples have done quite well. It completed this ABCD and a pretty big pullback as well, right at the 38.2% retracement of this low and 61.8% retracement of this low. Now whether it's a double topping or and then it rolls over remains to be seen, but looks like it might be a trading range affair for the staples now. Now if we take a look at the retail, so the retail index ETF, you can clearly see it's just not performing that well. It's just remain in this range. Found support from the 61.8% retracement, and now finding resistance from the 50%, just hugging the 89 period moving average. The momentum is not that great, looks like it wants to move lower actually. Then we take a look at healthcare. So the healthcare sector had actually performed pretty well. Look, every time it pulled back right to the 200-day moving average, which is the gray line, it had a really nice rally, went to the 1.618 expansion of this entire range. Now it pulled back right into the middle of the range. Looks like even the healthcare, I think, is range bound. Maybe it wants to do an ABC to the downside, but more of a range bound affair in that as well. Consumer discretionary had an interesting aspect is it has had a pretty nice rally, and it looked like maybe it wants to complete the ABCD, but the 1.272 expansion thus far proved to be a pretty strong resistance level. And with this kind of a move, it's with this kind of expanded bars moving lower, maybe it wants to come a little bit lower and touch this 89 period moving average. I would not rule that out as well, because it has actually broken this structural support. Now let's take a look at the industrials. So the industrials had performed really well, completed the ABCD exactly, and now they have pulled back, and it appears maybe they are in an ABCD correction, and 126, 125 might be a level they could pull back into, and we'll have the 89 period moving average nearby. Then if we take a look at the materials, they had also done pretty well, but now they are finding resistance right from these our key levels. The key thing is right where it's hugging the 200-day moving average. If it goes below that, then I think we're looking at an A, B, C, D to the downside towards the bottom of this trading range. So these are the key markets that we're looking at, and of course the real key point is where the market is at an inflection point. So we'll be watching the next 10 trading days really carefully, and I will keep you guys informed. Now if you want to get hold of these slides, then you can email me on marketchartpattern@gmail.com, and I'll be very happy to send you these slides. And if you want to be on a distribution list where I'm actually generating stocks which are doing 52-week highs and 52-week lows for the S&P 500 stocks, and also the London Stock Exchange, FTSE 100 and FTSE 250, it is a system that I'm developing. I'm more than happy to add you to the distribution list. It's free, there are no charges, at least it's free for now. And if you guys want to join that, then it will be something free for you guys for the foreseeable future. So now just one request. I have actually created a link, and I will be posting the link for donation purposes in the description of this video, and I will really appreciate if you have learned something from the channel and you want to donate something to the channel. It will really help me cover some of the costs for such a subscription to the TradingView. I spend quite a lot of time doing research, looking at the charts, and then present my research to you guys. So if you benefit through that, you have felt that you've learned something, then please do contribute to the channel. That way it will just help me to continue doing more research for you guys, and then I will be able to create more videos and also develop certain programs where I will be able to share more information regarding markets with you guys. So thank you very much for watching the video. If you learned something, you found video of educational value, please do subscribe to the channel, and if you do, then hit that bell icon button. That way you will know when the new videos are posted and you will not miss anything. So thank you very much. Good luck, good trading, and speak to you guys soon.